Hi, I'm Steve O'Hare. I'm a market veteran of over 30 years, and today I'm presenting a webinar on support and resistance on behalf of Fxview. Please take some time to read the risk warning and disclaimer. So today in the webinar, we're going to be covering a number of items regarding support and resistance. What we have listed them as is peaks and troughs, role reversals, market psychology, and round numbers. And all of these factors and components play a big part in support and resistance. So looking at this chart, this is a dollar Turkish chart. It's a weekly chart, but it very clearly highlights a trend higher. We can see prices have moved from the lows around about 340, 350, all the way up over time to a high around about 880. Now, prices haven't just gone up in a straight line. They've moved in what we call and what we are known as peaks and troughs. And these play an important role in support and resistance, as we will see further on in the presentation. These peaks and troughs, peaks are the highs, troughs are the lows or the swing lows or the swing highs, and they continue in a pattern of peaks and troughs as the price moves higher. So this is very, very important. These highs or these peaks can sometimes form resistance, and the lows or the troughs can can form support. Now, when we talk about role reversals, it's when support becomes resistance or resistance becomes support, and this all happens when price moves through it. On this gold chart, we've got a daily chart here, and we can see we posted a significant high at $1,960. The move lower or the swing lower formed a trough or a bottom. Support was found around about $1,760. And this led to a reaction in the price higher, which then again found resistance just in front of the previous high or previous resistance at 1960. Prices then reacted lower from here and again found support at the previous low. So again, you'll tend to find in charts this happens time and time again. The reaction higher was short-lived this time, and when prices did move through this support and move lower all the way down to around about 1670, 1675, that's where we found a base, and that's where buyers came in and supported the market. So from here, prices reacted higher, but as you can see, they stalled in front of what was previously a support level. And now, when prices react lower from here, this then becomes a resistance level. So this is where the role of the support has reversed into a significant resistance level. Again, prices reacted lower and found support at a previous swing low. And then when we reacted higher again, once more, this level acted as a good resistance level. Eventually, though, prices moved higher, broke through the resistance, and then what we tend to find is once that resistance is broken, again, it can reverse the role and become support, which it did only 5 or 6 days later. We found support at around about this 1755 level, with prices then catapulting higher in an impulsive move higher. Once more, we can see the same thing happening again. The prices moved back lower and found support yet again around this level. So you can see how significant this level has been throughout this whole period of time. Prices breached the low, but never closed below it, reacted higher again, and it wasn't until later that prices eventually moved lower. But again, we can see support was found at the previous swing lows. Now we tend to look for forward looking. We'll be looking at this level around about 1830 to act as resistance. And but this 1750 to 1760 area continues to provide a sort of pivotal glance of the charts. As markets move in trends, we can often see that we don't just get horizontal support and resistance, we also get trending support and resistance. And for this, we join up the swing lows, or on a downward market, we join up the swing highs to find the supporting resistance, the supporting trend line or the resistance trend line. So in this point, what we do, we join the two lows here and then extend the trend higher, and we tend to find that when we do find a very solid trend line, we'll have three lows that are joined, which forms that trend line. So we tend to find that if prices revert back to this trend line, we would find buyers or support around here. This is particularly relevant when we do also get maybe horizontal trend lines, which are also drawn at the same place. And when we get a confluence of trend lines, that's where we tend to find the more action or the more support. It makes it stronger from that perspective. Also, you can draw trend lines within trend lines. So as you can see, we've taken the swing low here, the swing low here, which is a higher low again, drawn that trend line in, and then even up to weeks or months later, we tend to find that prices, when they revert back to these trend lines, they tend to find some sort of support, especially if we've got further horizontal evidence of support also. So this is how trend lines work in an upward trending market, and they would be the opposite for a downward trending market. So the market psychology around support and resistance really is based upon the market participants. And for this, we categorize three different types of participants. The bulls, or the longs, or the buyers in the market are one classification. The opponents to that would be the bears, or the shorts, or the sellers, who would tend to maybe hedge their positions in a market. And also we have a third component, which is the sidelined, or the traders waiting for the market to reach levels which they are looking to trade at. So that's the market participants that we see that are important in trading. Also, there's a lot based on the significance of support and resistance line. So this tends to have also three major components to it. These can be highlighted as the price action. However the price action moves around support and resistance, this can be a good indicator of how significant the support and resistance is. The amount of volume that's traded at specific support and resistance level is also important. And not only that, but the amount of time spent at that support and resistance level. So the longer the time, the more volume, and the clear price action will build up the significance of a support and resistance line. Also, we look at round numbers as traders. Traders do like to see a round number. So when you're in an upward moving market, when you get to round numbers which end in 00 or 50, we tend to find a lot of traders will base their trading decisions around these big numbers. So we can have significant swing highs or swing lows around these high numbers. And this can result in the levels becoming major support or resistance lines. So it's really key to understand that. The professional traders will always be looking at these round numbers, knowing that retail traders will like to also trade around these numbers. So it's very important when you're placing stops or even trying to enter into a market to think about these big round numbers that traders will tend to target and tend to sort of like even try and move the price through these big round numbers to see if they can trigger stops on the other side of these. So I hope that's been informative, and thanks for joining me.